Welcome you all to the second session on the business finance course unit. So today's topic is time value of money, right? So under this time value of money topic, so we are going to discuss under this time value of money topic, we are going to discuss these types of things, these types of concepts, and at the end of this session, you will be able to explain the concept of time value of money and interpret the interest rate as a required rate of return, discount rate, or opportunity cost, and solve time value of money problems for different frequencies of compounding, and calculate and interpret the future value, present value of cash flows, and also you will be able to have a clear understanding about the cash additivity principle. So these are the few learning outcomes that we are trying to achieve through this time value of money topic, right? So with that, we will move on to the topic. Right. So what do you mean by time value of money? Right. So in the basic principle, this is a basic principle of finance. That means the time value of money is a basic principle, or it's one of the fundamental principles of finance, where you all must have heard that we say that a dollar today is worth more than a dollar tomorrow. The money that we are having today is worth more than the money that we are getting in a future date. So, with that understanding, or with that with that knowledge, we have to identify what time value of money is, right? So the time value of money can be explained through this particular quote which I have mentioned you previously, that is, a dollar today is worth more than a dollar tomorrow. So the people, so what we say is the people highly value the money that they have today than the money that they are receiving in a future date, right? So that is because of the time value of money, right? So based on so these days we are talking about the currency depreciation and how it is impacted to the economy and to our purchasing power as well. Right. So when we are talking about all these things, it includes the time value of money concepts. So that means when we are considering about the money that we are receiving, the money that we are receiving today is highly valuable or highly worthy, or it worth more than the money or than the same amount of money that you will receive in a future date, right? It says individuals value a given amount of money more highly the earlier it is received. So you all know when somebody asks you to give some money, like when you lend some person a particular amount of money, you like when they pay you at the earliest, right? So we like to receive money earlier, or we like to receive the money fast as possible than keeping those money to receive those in a later date. So that is why we say it as a dollar today is worth more than a dollar tomorrow, right? So then that is why we say that people are like willing to get a small, even though people are getting a small amount of money today, they prefer that money over a large sum of money that will be received in a future date, like 3 to 5 years, right? Or 6 months, or any, like, you receive. So in our case, in our individual scenario, we like to receive money today rather than receiving money tomorrow, because we think that if we receive some amount of money today, we could have spent that in a um, spend that for a particular purpose, or we can invest that money in particular avenues. So therefore, we like to receive money as fast as possible, right? As fast as possible, rather than keeping or rather than waiting to receive money in a future date. So, with that understanding, we will move further, right? And also, this slide says that a small amount of money now may be equivalent in the value to a large amount received at a future date. So you can identify that by referring to our daily scenario, right? In last year, what happened? The price of a bread, or price of a loaf of a bread, or price of dal, price of rice, and price of each and every good were lower. However, if we think about, so let's say, if I take an example, let's say previously 5 to 10 years, like three, two to yeah, let's say 1 year back, a uh, price of a notebook or price of a pen was like 20 rupees or 30 rupees. Now, what is the price of a pen? It's around 70 rupees, 50 rupees. So we have to, like, the same pen that we bought 1 year back was worth, or was low cost, was had a low cost than the same pen that we are buying today. That is why we say the small amount of the small sum of money is equivalent to a large sum of money in a future date. So we are having a small amount of money today, and that can be equivalent to a larger sum of money that we are receiving on a future date. Why is that? That is because of the currency depreciation. Previously, if we previously we paid 100 rupees to buy a loaf of bread. However, now we have to pay nearly 300 rupees, so 150 rupees to buy that same loaf of bread. Right. So therefore, this good doesn't change. However, the small amount of money is equivalent to the large amount of money that we are receiving in a future date. Right. So what is time value of money? TVM, in the sense time value of money. So the time value of money deals with the equivalence relationship between the cash flows occurring on different dates. So here in the time value of money concept, we are discussing about the relationship between the cash flows. So you know what a cash flow is. That is the money that we are receiving or that we are paying. So those cash flows or cash inflows or cash outflows can occur in different time periods. Sometimes if we if we invest in a particular investment avenue, so you are investing today. However, the money that you are receiving will uh, like uh, will come to you in 6 months time. Some amount of money will come to you in 6 months of time, and some amount of money will be received in 1 year's time and 3 years time. So the time periods are different, right? So here we are dealing with different cash flows with different time periods, and we are trying to equal those relationship between those cash flows that occurred in different time periods. So the relationship or the equivalence relationship between the cash flows occurred in different dates are known as the time value of money. Right. So with that, we will move forward. And so this also explains what is time value of money. That says the equivalence relationship between the cash flows occurring in different dates. So that is what I have explained you previously. The cash flows that occur in different dates, or the relationship between the cash flows that occur in different dates, are known as time value of money. And there's an example given. You receive 9,500 rupees today from your friend and pay back him 10,000 in 1 year, 1 year from now. Then these amounts can be considered as, can be considered as equivalent. So today you are receiving, or today you are borrowing 9,500 rupees from your friend, and in 1 year time period, that means today you are purchasing, like today you are borrowing 9,500 rupees from your friend, and then you are paying back him 10,000 rupees from 1 year time period from now on. So then what will happen? So if are these 9,500 and 10,000 rupees are equivalent, so based on the time value of money, we say these 9,500 and 10,000 rupees are equal, are having the same value. So if you like just think, you have like you can like you can see that, sometimes you might think that how can this 9,500 can be equal to 10,000 rupees. So there's 500 rupees more in 10,000, even though we are receiving in after 1 year time period. So why we are saying that this 9,500 and 10,000 rupees are equivalent is based on these things. That is because the 10,000 worth of payment you made the payment is made from 1 year from now on, is lesser to you, than 10,000 payment made uh, now or today, right? So uh, the amount of money that you are getting today is 9,500. The amount of money that you are getting today is 9,500, right? And so that, and you are paying your friend 10,000 rupees from 1 year time period. So today you are getting money, and after 12 months time you are paying 10,000 rupees for your friend. So now we are telling that these 9,500 and 10,000 rupees are equal. So why we are saying that equal is mentioned in this first and second bullet points. So if I explain that to you in this way, so let's see. And so let's say the 10,000 rupees that you are receiving today and the 10,000 rupees that you are receiving from 1 year time period is equal or not. Is not equal, because the 10,000 rupees that you are getting today has a high value than the 10,000 rupees that you are getting in future or in 1 year from now. So why is that? That is based on the currency depreciation. And so you know that if I explain you simply, right? So you know the amount of goods that we were able to purchase from 1,000 rupees in back in 2 years are very high than the amounts of goods that we can purchase from 1,000 rupees today, right? That is based because of the price of goods have been increased, and that is because of the currency depreciation. And simply by considering all these things, what we can say, that is because of the time value of money. So therefore, the 10,000 rupees that we are getting today is not equal to the 10,000 rupees that we are paying from 1 year period from now on. So if this 10,000 rupees that we are getting today is not equal to the 10,000 rupees that we are getting like in a future date is not equal, right? So what then, if we are like, then in order to, so if we go into this particular example that I have explained you receive 9,500 rupees today, and you are paying back to your friend 10,000 rupees in 1 year time period. So I say that even though this has a difference of 500 rupees, this 9,500 and 10,000 rupees are equal. Why is that? Because the 10,000 rupees that you are receiving today is not equal to the 10,000 rupees that you are paying, that you are receiving from 1 year time period. That is because of the currency depreciation. So if this 10,000 rupees scenario is not equal from today and from 1 year time period, if we want to, if we want to give our friend some amount of money that is equal to the 9,500, what we have to do, we have to provide a value higher than 9,500. Why is that? That is because the 9,500 rupees that he gave us today is not the 9,500 rupees that we should pay him after 1 year, because of the currency depreciation. The value of currency has been depreciated. Therefore, if we want to if we want to give some amount of money that is equal to the amount that we receive today, we have to pay a high rate. So that is why we are paying this 10,000 rupees. And on the other hand, if we receive 10,000 rupees, and if we receive 10,000 rupees in future, the 10,000 rupees that we are receiving in future is not 10,000. It doesn't have a worth of 10,000 rupees, or cannot that 10,000 rupees cannot be used to purchase the same amount of goods that we purchase today by using 10,000, right? So therefore, we have to calculate and see how does this 9,500 and 10,000 rupees can be equal. And the method and the way that we are equaling, or the way that we are telling or equaling this relationship between these 9,500 and 10,000 is known as the time value of money, right? And the interest rate is the rate of return that reflects the relationship between differently dated cash flows, right? So you have some amount of money today, and you receive 9,500 rupees today, and that 9,500 rupees and the 10,000 rupees that you are paying after 1 year time period is equal. Then you can think that how can this 10,000 rupees and 9,500 rupees can be equal? There's a difference between 500. Then the 500 rupees, or the difference of that 10,000 rupees and the 9,500 rupees, that is the 500 rupees, can be considered as a compensation of the compensation or the return that we are receiving for giving the money, for receiving the money in a future date rather than receiving it today itself, right? Our friend is giving us 9,500 and we are receiving the 9,500. However, we are not paying him back the 9,500 today itself. What we are trying to do is we are paying him back this 9,500 or 10,000 rupees from 1 year time period. In order to equal that 9,500, in order to get a equal value for today's 9,500 after 1 year, we are paying 10,000 rupees. Then that is the compensation that our friend is getting for giving us the money for 1 year time period, because he is not having, or he forgoes this 9,500 rupees for 1 year time period. If we have if he didn't give us money, right? If he didn't give us money today, and he keeps that money in the in a bank account, he could have received, he will receive some amount of interest, right? So in order to compensate that, in order to compensate the money that he is giving us today, we are paying a return for him, right? So that return is known as the interest rate or the required compensation or the return stated as the rate of return. So the return required or the required compensation or the return stated as the rate of return can be calculated by taking the difference between the money that we are receiving today and the money that we are receiving on a future date divided by the money that we are receiving today multiplied by 100. Then our friend is getting an interest rate of 5.26%, 5.26% for giving us money today for 1 year time period. So that is how we are calculating the interest. Right, so that is the interest. And the next one, the interest rate can be taught in three different ways. The first one is required rate of return. Right, so the same interest rate that we calculated previously, that is 5.26, can be taught in three different ways. The first one is the required rate of return. The required rate of return is that the minimum rate of return an investor must receive in order to accept the investment. Right? So here we are not talking about the lending and those things. We are talking about the investment. Right? So if that particular person is getting money or is getting the money or the return, or they should these investors should get a return for giving or for foregoing that money, foregoing some amount of money for a particular time period, right? If those investors have those money with them, they would have invested or they would have consumed those goods or those money. And by sacrificing that consumption or investment, they have given us the money. Therefore, we have to compensate them. So the minimum amount of compensation that they require for giving us the money are known as the required rate of return. Required rate of return is the minimum rate of return an investor must receive in order to accept the investment. If we receive the minimum required rate of return only, they are giving the money. And the next one, discount rate. 5.26 is the rate at which we discount future amounts, 10,000, to find its value today. Right? So we can use we can use the interest rate of 5.26%, and we can discount 10,000 over the future value by this discount rate, which is 5.26, to find its value today, right? And thirdly, the opportunity cost. If the party who supplied 9,500 had instead decided to spend it today, he would have given up earning 5.26 on the money. So 5.26 can be viewed as the opportunity cost of current consumption. If that person, if that person um, if that friend who gave us the 9,500 rupees didn't give us money and he spent that money, so he would have spend it today, he would have given up 5.26%, right? So because if he lend us after 1 year, we will give 10,000 rupees, which includes the 5.26% interest. So therefore, if we forego, or if he refused to lend us money, he would have forego this 5.26%. So that is also that can be also identified as the a type of interest rate, which is the opportunity cost. Then, right. So what we have to identify is that time value of money is the equivalence of cash flows that occurred in different time periods, and the interest rates can be classified or can be identified in three ways, right? The first one is the required rate of return, the second one is the discount rate, and the third one is the opportunity cost, right? And then the different interest rates. When the investment pays interest more than once a year, the financial institutions often quote an annual interest rate rather than quoting a periodic interest rate. This annual interest rate is referred to as stated annual interest rate or quoted interest rate. The expression of the rate will typically be followed by an indication of how often interest is calculated. Example, 12% compounded monthly. So we have sometimes we have interest, or sometimes we have instruments that pay interest annually, right? Sometimes we can get interest annually. In some scenarios, we can get interest semi-annually or quarterly, right? So then, without stating the annual interest rate, or without stating a periodic interest rate, the interest rate for this time period, so we calculate a annual interest rate. So under this annual interest rate, we calculate it for annualized purpose, right? So for an example, so if we say 12% compounded monthly, then you know this interest is added, or interest is calculated on a monthly basis, right? That's a 12% is the annual rate, and this 12% interest rate is compounded monthly, and interest is calculated monthly, it is added monthly. So how are in those type of scenarios, how are we going to find the amount of money that we are getting monthly? So it's simple. So if it's 12% monthly, 12% compounded monthly, then month if you have compounded period as monthly, so then the interest rate should be divided by the number of months. You have 12 months for 1 year, then you divide by 12. Then 1% monthly is the interest rate for 1 month period of time. That is how we are calculating. Right. So, and another very important thing is that the the timeline that we are explaining. Right. So, here you can see in this timeline, the zero part, uh, you have to like, in a timeline, right? In a timeline, the zero is the today's value. 0 point indicates the today's value. Every time, in every scenario, 0 is the today's value. And 1, 2, 3, 4, you can draw a line, and you can draw for the periods that you want in your calculation. And here in 0, as I told you previously, 0 is the today's value, and that is the beginning of period 1, right? Today's value is 0, and that is the beginning of period 1. And the first value, or number 1, the period 1 starts in 0 and ends in 1. And at the end of the period 1, it's the beginning of period 2. And in the second place, it is the end of period 2 and the beginning of period 3. Right? From this part to this part, period 1. Right? And this part to this part, period 2. Right? So that should be identified when you're drawing a timeline. Right? So if when you're doing all your calculations, it is required or it is advised to draw a timeline, because it will make it simpler for you to do the calculation and to understand the scenario. Right? Then the future value. Right? So in the as I told you previously, the time value of money concepts explains the equivalence of cash flows that are occurred in different time periods. Right? So because we are talking about the cash flows that are occurred in different time periods, we have to come across with future values, present values, and many other things, or the time periods where interest is calculated likewise. Right? So the first thing, right, or the jargons that you have to remember are those the future value, a single cash flow, or lump sum, compounding, discounting, right? So we will talk about all these things one by one. So what do you mean? This is the formula that is used to calculate the future value of cash flows, right? This is the formula that we are using to calculate the future value of cash flows, right? This is used to calculate the future value of cash flows. So what is this FVN? That is the future value. F in the sense future, V is value. And PV is the present value. R is the interest rate. N is the number of periods. Right? So if you want to calculate the future value of a cash flow, the formula that you should use is this. That is FV equals PV into 1 plus R to the power N. This is power. This is power N. This is multiple sign. Right, here also I have given all these information. That is FVN is the future value of the investment. N is the number of periods from today. PV is the present value of the investment. R is the rate of interest per period. Right. And when we are finding the future value of cash flows, we move the cash flows forward in time. Right? If, as I told you previously, so we say this 0 point is the today's value. 0 is the today's value. If we want to find the cash flow value in second year, what we got to do? We have to compound. So that means we are moving the cash flows forward in time. All right. So that is why we say we are forwarding the cash forwarding the cash flows in time. So that is what is known as compounding. If we are taking the cash flows forward in time to calculate the future values, it is known as compounding. Right? And we can have an example. So suppose you invest 100 rupees in a bank account paying 5% annually. Calculate the future value at the end of the first year. Right? So you have 100 rupees today, and you can you want to know the amount of money that you are receiving after 1 year. So then you can use this formula. 100 is the present value into 1 plus R is 0.05 is the interest rate, which is 5% annually, and to the power 1. 1 is because we are calculating the future value for the first year. Then by solving this function formula, you will get the answer as 105. Right? The future value of 100 rupees after 1 year is 105. Right? And the same scenario is explained by using a 2-year time period. Right? 2-year time period. Then, and so how are we going to calculate the 2-year time period? So that is why we say like we have to calculate the cash flows in 2 years time period. That is the present value is 100. And for 1 year time period, we multiply by 1 plus r to the power 1. That is 1.05 to the power 1, then 105. And after 105, after the end of the first year, we receive 105 rupees. And in the second year, in order to calculate the cash flows that we receive in the second year, what we need to do, we can multiply by again 1.05. Or else, by using this formula, we can do that very easily. So how are we going to do that? So the present value is 100, right? They have given the present value as 100, right? And it is 1 plus r is 0.05, right? We have to take the future value of 2 years time. Then we get the answer as 110.25. Right, as 110.25. So how are we telling that this 5% is getting 0.05 is becoming 0.05? I'm sorry. So that is because we have 5, right? 5%, right? That is the percentage. So 5%, in order to make it a decimal, we have to divide it by 100. Because we are divided by 100, it becomes 0. When you are dividing by 100, 2 decimal places are coming, right? So that is why we say it as 0.05. And we have placed the initial investment value at T0. Then we move the present value forward by T2. And by the factor 1 plus r to the power 2, the factor is called as the future value factor. Right? This factor, this part, this part is known as the future value factor. Right? And the next one. So the same calculation is shown in another way. So you know the original investment here is 100 and the interest for the first year is, so you can calculate the interest for the first year separately. That is 100 rupees and 0.05, that is 5 rupees. And the interest for the second year based on the original investment is again 5. So how are we going to calculate this interest for the original investment? Right? How are we going to calculate? That is the principal amount or the original investment. Original investment into interest rate, right? Then the original investment into interest rate is this, right? So you have the original investment of 100 rupees, then you have the interest rate of 0.05 or 5%. Then for each of the years, you are getting an interest of 5 rupees. And then for the second uh, year, you are getting interest on interest, right? So for the first year, you are having only the original investment. However, when you are going to the second year, we have the interest that we get after, or the interest that we get for the first year as well. That is 5 rupees. So for the first year's interest, we have to calculate interest again. That is interest on interest. Then we get 0.05. Then the total or the total future value will be 110.25. Then it is known as 5 rupees interest that you earn each period on the 100 rupees original investment. That is known as the simple interest. Right. So here, based on the interest calculation, we are categorizing the interest into two types. That is the simple interest and the compounding interest. So here, in this scenario, we calculated the simple interest, right? That is the interest on the original investment. However, in this part, we calculated interest on interest, right? So that is the compounding interest, right? So you have two types of interest. The first one is uh, simple interest, and the second one is the compounding interest, where we calculate the interest on interest, right? And the extra 0.25 that you have at the end of the year 2 is the interest that you earned on the year 1, interest of 5 rupees that you reinvested. This provides the first sign of the phenomenon known as compounding. So here, what we have to identify is that every time we say the interest that we are receiving will be reinvested. So we are not taking and spending that for our consumption purposes. The interest that we are receiving will always be reinvested. That is why we are calculating interest on interest or compounding interest in the second year. And then the effect of compounding. So, as I told you previously, we have two things, that is two interests. So, the first interest is the simple interest, where we calculate the interest on the principal component. And secondly, we have interest on interest, right? That is known as compounding interest. And we can calculate the effect of compounding by taking the difference between the compounding interest and simple interest. So calculate the future value of investment of 100 rupees, which offers 5% interest with 100 years maturity based on the simple interest and compounding interest. Simple interest is 100 plus 100 is the principal amount, right? That is the principal amount, P, plus the interest, simple interest, that is the principal amount, into interest rate into number of years. That is how we calculate the simple interest. So the simple interest is 600 rupees. And when we talk about the compounding interest, that is where we calculate the interest on interest, can be calculated by using the formula which I have explained you previously. right? That is future value equal present value into 1 plus r to the power n, right? So here the present value or the principal amount is 100 and 1 plus r is 0.05 to the power n. Here we have 100 years. This is power, right? Then the answer will be 13,150.13 cents, right? So then what we have to do is we have to calculate and see what is the value added through compounding. So you can see that the same principal amount, same time period, and the same interest rate. So how can these rates be different, right? Here we are getting 600, here we are getting 13,150.13 rupees. So then in order to see the value added through compounding, what we can do is we can get the compounding interest deducted by the simple interest. Then the difference is the value added through compounding. That is 12,550.13 cents, right? And then there's another thing that we need to explain by like taking this value added through compounding into consideration. That is the effect of compounding increases when the interest rates increases, right? The effect of compounding increases when the interest rate increases, right? So that is the maturity value of the investment of 100 rupees with the 10-year maturity and the interest rate of 5% and 10%. So all the other things are equal, right? All the other things are equal. However, principal amount is equal, the time period is equal. However, this interest rate is different, right? Interest rate is different. What you can see, the interest rate, when the interest rate is 5%, the future value that is getting, that this person is getting is 162.89 rupees. And when the interest rate is 10%, they are getting 259 rupees and 37 cents, right? So what you can conclude here is that when the interest rate is higher, the future value is, or the maturity value is also higher, right? If you want to get a higher value, then the interest rate, you have to invest in an investment that gives you a high interest rate, right? And if the compounding increases when the number of compounding increases. So if even though the time period is equal, right? The principal amount is equal, the interest rate is equal. However, the time period is different, right? If you invest 100 rupees at 5 percent interest for 10 years, you will get 162 rupees and 89 cents. However, if you invest that same amount for 100 years, you will get 13,150 rupees and 13 cents. So then if you have some amount of money, and if you want to get interest, or if you want to get a high return, uh, and where the interest rate is same. So what you have to do, you have to invest, or what you have to keep that money for a invest that money for a longer time period. And so what you can identify by using these two scenarios, right? When the interest rate is higher, value is higher, and when the time period is higher, value is higher. So these are very important in order to identify or understand the time value of money concepts. Right. And the next one is a question that you can do, right? So I will explain how to do this question. So firstly, we will go through the question. It says that a loan that is 10,000 rupees has been issued for 5 years with an interest rate of 8%. Compute the amount to be repaid to the lender based on both simple and compounding interest, and identify the value added through compound. This is a scenario, or this is a calculation that we did here. So we will do this calculation. Right. So I will just write the values, right? We have, as I told you previously, we have two things. Interest can be, I will interest can be categorized into two parts, right? Simple and compounding, right? So in simple interest can be calculated by multiplying the principal amount into interest rate, right? And to number of years. That is it. So I will firstly do this. Okay. Then you have to find the amounts that need to be repaid here, right? The principal amount is 10,000 rupees. And the interest rate is 8%. Firstly, we will calculate the amount that needs to be repaid, right? Repaid. Right, amount that needs to be repaid includes the principal amount, plus simple interest. Right, the principal amount is 10,000 plus in simple interest 10,000 into 8% into 5 years, right? Then 10,000 plus this amount is 4,000, right? The amount that needs to be repaid is 14,000. Right. And on the other hand, I will calculate the compounding, right? Interest. And that interest compounding is the interest on interest, right? Amounts to be repaid, the same thing. Amount to be repaid is the principal and into the compounding factor. Compounding factor, right? So here the principal amount is, or else we can say principal amount into 1 plus r to the power n. Same thing, right? And principal amount is 10,000. The compounding factor is 1.08. How we get 1.08? I will explain you that again. 1 plus 0.08, right, into 5. Into in the sense to the power 5. Right, then 10,000. 1 plus 0.08 is 1.08, the power 5. Then the answer is 14,693. If we, because we want to calculate the value added through compounding, so how we are going to calculate the value added through compounding? We have to deduct this, the value added is equal to the amount to be repaid in the compounding interest, 14,693 minus 14,000. Then the value added through compounding is 693. Right. Uh, then so that is the value added through compounding. And so in finance, we consider the compounding interest. In finance, we consider the compounding interest as the interest that we are using. And for if unless you are told to calculate the interest based on the simple interest, so you have to use the compounding interest in your calculations. Right, so you can see that even though the principal amount is equal, and even though the interest rate is equal, and even though the time period is equal, the values or the things or the value amount to be repaid can be highly variable or highly vary based on the way that you are calculating the interest. So that is why we say the simple interest is not taken in finance, because generally we say in finance, when we are investing all the money that we are receiving as interest also. So that is why we are calculating interest on interest. And therefore, as as we are not using this as we are not taking interest on interest calculation in the simple interest. So the interest calculation or the interest method that we are using should be compounding interest. So this is the answer for this question number 1, right? So with that, we will continue the second part, the second section or the next slides in the second part.